Fair value gap, a very powerful trading setup used by institutions and prop desks around the world to make profits. But it is very often used in the wrong way, and that is what we are trying to clear in this video. So fair value gap, you might have seen it multiple times in your daily chart trading sessions, where a large red candle or a large green candle is being formed, and in that place there is a possible fair value gap being formed. It is very often used to trick retailers. So it means that if you study this concept really well, you can increase your probability of profits in such fair value gap trading situations. So in this video, first we'll learn what is a fair value gap. Then we'll get into how do you identify it. Third, we'll get into possible time frames that you should be looking into. And four, we'll be getting into entry and setups for your trade systems. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to Market Feed. So before getting into trading setups, first we have to understand what is fair value and how do you identify it. So if you remember our previous video on volume profile, I'll give you the link here in the I button. We talked about a fair value zone. What is that fair value zone? It is where the rightful trading price of a share should be. And we also talked about certain situations where this fair value zone, it will be broken. And in those setups, we talked about buyer and seller imbalance. Okay. The fair value is supposed to be the right trading price of a share or a security. So once there is a buyer and a seller imbalance, a large candle could be created where a fair value gap could exist. Okay. So if there is no imbalance, buyers and sellers are very, very strong, price will move very much sideways. Okay. There won't be any fair value gaps created. But whenever there are large candles being created, for example, this one, you should be looking into whether a fair value gap exists there. So first, I hope you understood the definition of what a fair value gap is. It was supposed to be a zone where the stock or the security continued to trade. But because of a large candle, let's take for example this large red candle here, because of such large red candles or green candles, a fair value gap was created. A buyer and seller imbalance was created. And those zones might prove to be very important whenever price retraces to it. Okay, that is what fair value gap is. Now, let's try to understand how do you identify them. So to identify a fair value gap, you have to look at a 3-candle setup. A candle where a first candle is a very small candle, the second candle or the middle candle is a large candle, creating a fair value gap there potentially, and the third candle again is a very small candle. So I'll give you what exactly makes a 3-candle setup a fair value gap situation. So if the high of the first candle is having a gap or is not touching the low of the third candle, okay, if the high of the first candle is not touching the low of the third candle, that what does that mean? That means the second candle was very big, right? In that situations or in situations like that, a fair value gap is created. And here in this example, if a green candle is what the middle candle is, we call it as a bullish fair value gap. And in an example where, let's say, the middle candle is a red candle, let's take this example. Okay, the low of the first candle here, because it is bearish, we have to take the inverse. And the high of the third candle, it's having a gap in between because of a large red candle in between. This is a bearish fair value gap setup. So if you have understood that, you're halfway done. You have understood what is a fair value gap, why it exists, right? There is an imbalance between buyers and sellers, hence it exists. And if the price reaches back to that zone, there is a high chance that fair value will be respected and the price will move back from there. Okay, so that is what a fair value zone is. Now, instead of drawing or identifying fair value gaps on your own, we can use a simple indicator on TradingView. For that, you have to open TradingView. Again, it's not a paid promotion. We're just sharing it here. And this is one of the free features in TradingView. So you can come here into the indicator section and you can type in fair value gap. You'll find this fair value gap by Luxalgo. Click on that and you'll be getting the indicator here. Okay. So what did we say earlier? This was a possible fair value. Automatically, the indicator gave us that fair value setup. Okay. We gave a bearish fair value setup as well. And automatically, once again, the indicator has caught that and it's giving it to us. We don't need to think about how to find a fair value gap. The indicator will do it for us. But as always, you need to understand the theory. Only then can you get into the practical side. So now that you understood what is a fair value gap and how to find it, along with the very easy indicator, let's look at how a possible trade setup might be. Okay, again, it is very simple. Here you have to just look at the price here created a bullish fair value gap, and the price moved up and it moved back down. Now the theory states that if a retesting of the fair value gap is happening, there is a high chance for the trend to continue. Okay, usually we expect that, hey, the price reached somewhere here, now it lost all trend and it's going to fall back down, right? That's the usual assumption that a lot of traders will have, and that's how retailers are often tricked by institutions. But because this fair value gap is very likely to be respected, there is a high chance that price after touching this fair value zone will bounce back up, and that's a really good situation for you to buy low and sell high. And in a possible trade setup, what will be your stop loss here? Your stop loss will be whenever that fair value zone gets broken. Okay, let's take this live example here in the chart. Once again, a fair value gap was created because of this large red candle. Okay, because of this large red candle, a good fair value gap was created. And when the price enters back to this zone, you can take a short trade. Okay, you can take a short trade with a 1:2 risk to reward ratio. And your SL will be where? Your SL will be the topmost point. Again, this is a bearish setup. Hence, your SL will be whenever the fair value is broken on the upper side. And here, currently the market is running. It could go ahead and hit our SL, but make sure you watch this trade today. The theory states that there is a high chance for the stop loss not to be hit, the fair value to be respected, and for this to come back down and hit your target. Okay, as always, there is no fundamental theory or strategy which has 100% profitability rate. And similarly, even in the fair value zone or the fair value gap theory, you will find the same, right? There will be winning situations, there will be losing situations as well. I showed you the example in Nifty. Here, I'll take the example of Bank Nifty also. But here you can see multiple situations where Bank Nifty actually respected the fair value zone. Okay, here you can see the last big fair value that was created. Bank Nifty came back to this zone and it gave a retracement. It again came back to the zone, but again it was retested, or it again moved back up. Okay, it retested the higher highs and gave a strong breakout here. Now you understood a very easy concept, how it works, how you're supposed to use it, a very easy indicator to understand it, and you understood a possible trade setup also. But again, still you're not done. You need to understand some very important concepts before you jump into the world of trading fair value gaps. The first thing is, not all fair value gaps are equal. Okay, there might be very small fair value gaps. Let's take this one. Or there might be very large fair value gaps. Let's take this one. Always a larger fair value gap is going to be more strong because the price has a larger tendency to reach back into that zone and take a bounce back from there. Smaller zones have less probability of being respected. And here in this chart, it is relative, right? It is relative. You can consider these to be larger zones. This one, and even these ones. You can consider these to be larger fair value gap zones, and the smaller ones you can choose to avoid. And one more very strong point. So let's say in such a setup where you are observing multiple fair value gaps, okay, such that in a situation you're seeing in a particular day a lot of fair value gaps being formed here, right? Here in this situation, you should be looking at the fair value gaps which are below a certain zone. So I'll tell you how to find that. First, you can come here onto the left side of TradingView and you can go to Fibonacci. Right? You can either take Gann box or the Fibonacci retracement tool, whichever is more easier for you. And you have to plot the swing low to the swing high. Okay, so you have to plot the swing low to the swing high, and from here you have to understand whatever fair value gaps are falling below the 0.5 mark. Okay, below the 0.5 mark or below half of the rally that has happened, you can consider those to be more strong. Okay, because in a rally, there will be multiple fair value gaps, and in a situation like this, the largest or the most powerful will be the ones which are on the lower side. The ones which are forming much below, these lower fair value gaps, they'll be much more strong. Understand these two concepts really well, and I'm sure you'll be becoming a much better trader. Okay, so then let's move ahead. So here we have discussed a very strong theory. Okay, the theory says that if there is a large candle being formed in between two smaller candles, there is a high chance for the price to retrace to that level and for the price to move back up from there. Okay, this and that zone is called as a fair value gap. Okay, you understood how to find it, you understood all the rules that you should be looking into when trading fair value gaps and to increase your probability of profits. And that's where I want to get into why I'm doing the strategy videos in the first place and to solve for money management for you. Last month, we did the volume profile video. A lot of you told me that you learned a really good concept there. Okay, but here I want to re-establish the fact that why do different concepts exist and why do we tell you about it? Okay, so I'll tell you my mindset. I feel that to become a better trader, you don't need to by heart all of these theories, all of these trading setups and try to follow every single one. Okay, you need to understand, or you need to evolve into a place where you understand what the market structures are, what other players in the market are thinking, what the institutions are thinking, how the price could move in different various scenarios, and you're learning all this theory so that one day you'll get that practical, you'll start getting that practical spark inside your head. Okay, that's the aim here. So hope that is very clear. I'll give you an example. So marketfeed earlier used to run option selling courses. Okay, we used to run option selling courses. We no longer do. We only have our automated trading product. I'll have the link in the description. But when we used to have our earlier option selling courses, Sharik used to run them, I think more than 2 years ago, right? A lot of option buyers used to join those courses. And we thought, hey, this is a very different thought process. Why are all these option buyers who are not at all interested in option selling, why are they joining this course? Then we understood that all of them came here so that they can understand what the enemy, right? Option buyers, they have option sellers in their head as their enemy or the ones they're fighting against. And if you know what the other person is thinking, you have a much higher probability of profit in your own trades. You'll understand situations better and you'll in fact take better trading decisions yourself. Okay, you might not learn every single concept here by heart and try to use it or improve your trading setup, but just listening to it by understanding it, right, getting it into your heart, you'll understand what others are thinking in the market, and that will take you to great places. It's like people complaining on Instagram or on Twitter how the maths they learned in school is very much useless to them. Okay, but I do believe that whatever mathematics you learned, even including the Pythagoras theorem, even including your sine, cos, tan, and any trigonometry, it improved your logical reasoning skills. And with that, your daily tasks, without even you knowing, you're able to take better decisions even today in your life. Okay, that mathematical way of thinking, that analytical way of thinking would have definitely improved because you learned all of those concepts. And just like that, you have to understand this concept just for that reason, I believe. Okay, you shouldn't take the exact trading setup. That's not even the point here. You should get into your heart that why this concept exists and how can you use it to better your own trading setup. That's how you should be thinking here. And coming into the money management part, it is super important, especially for this strategy. So this strategy does not have a high win rate. Okay, when you can run your own back test by using this very simple trading indicator that I shared, and using that you can see that it doesn't have a very high win rate, but when it does win, it will give you a good risk to reward ratio. So in situations like this, you have to understand and you have to hold the money management rules to your heart, because in drawdown situations there is a chance for 50% or 60% of your trades to go into loss. The rest might be in profit and might take you to a lot of profits, but these 50% trades going into loss should not blow up your capital. So money management should be super important, especially for a low hit rate strategy. And since you stayed till here and you heard about the psychology in which you should approach new trading strategies, and you also heard about the money management techniques, I want to fill you in one more unit of crucial information. Okay, so whenever we think about a strategy, we always think about, hey, you got an indicator and this indicator should be giving you the trend, it should be giving you an entry setup, it should be giving you an exit setup as well. But try to break all of those three differently and you'll be getting amazing trading strategies. So what does that mean here? Try to split trend criteria into one category, try to split entry criteria into one category and exit criteria into another. Okay, try not to combine all three of them because that's what beginners think and they make a lot of mistakes and a lot of losses. But here in our quant research team inside MarketFeed, this is one secret analytical way that we think. I'm sure the team would not be happy that I shared it with you, but that's the point of this channel, right? We want to make sure that you get the most actionable and practical content on stock market investing and trading out there. So that's it for this concept. I hope you really like the video. Make sure you hit the like button and subscribe if you like the content. This is Ajay Ajith signing off. See you all again. Bye bye.